Hello, and welcome to our Breakwave Day 2022 event. I'm John Kartsonas, founder and managing partner of Breakwave Advisors. So this is our second annual event following last year's inaugural Breakwave Day, an event that proved quite successful and led us to the decision to continue the tradition. Over the next 2 hours, you're going to hear views and opinions related to commodity shipping, mainly dry bulk and tankers, from some of the brightest minds in the industry. Now, make no mistake, the last year has seen some of the most dramatic developments in both of these industries, with significant disruptions due to an ongoing war, wild price swings in both shipping segments, and ongoing government interventions in capital and currency markets, great affecting global trade that once again might only be a preview of what is to come for those sectors in the year forward. Yet, when there is uncertainty, volatility increases, and the potential for higher returns come into play. So here at Breakwave, we always strive to provide as much information as possible to all investors from institutional-like sources, and make such information that only professional investors used to have accessible and free for all. Today's event is part of such an effort, which combined with our frequent publications and updates in our Insights page, should hopefully continue to add value to an investment process in such exciting industries for all of us to invest and trade. Now, before we begin, I would like to mention that this is a live event, so I would like to apologize in advance for any mishaps during this broadcast, which includes presenters and participants from all around the globe. So now, with no further delay, I would like to introduce our first segment that focuses on the current state of the dry bulk market, as well as the outlook for the years ahead. We're very excited to have with us our first presenter, who is, in my opinion, is one of the most rounded analysts out there in the dry bulk industry. Alexandra Alatari, who is with Braemar, is a senior shipping analyst and has recently been offering some very interesting thoughts and analysis, not only by focusing on the microcosm of dry bulk shipping, but also by incorporating a complex world we are living, geopolitics and the broader macro environment that has been greatly affecting shipping markets lately in a greater degree than before. So with that, I would like to introduce Alexandra from Braemar. So good afternoon, Alexandra from New York. The floor is yours, and please go ahead with your presentation.
Thank you very much for the kind words, John. Much appreciated. So I'll just jump straight into it. Today we'll present our dry bulk market outlook. We have prepared a high-level presentation, and we want to highlight the main drivers for the market, not just for the year ahead, but also for a few years down the line. Next slide, please. I would hate to bore everyone with a historical overview over what's already happened. So instead, I'd rather establish where we currently stand and serve as a starting point to our discussion. Next slide, please. We are all aware that the freight market has very sharply corrected downwards in the second half of the year. The bigger dry bulk carriers, Capesizes, even saw their earnings drop below OPEX levels in Q3, while medium and smaller sized ships managed to find a floor at much more decent levels. Currently, earnings across the board are at roughly the same levels, around the mid-teens, and let's see why, starting with the fundamentals. Next slide, please. Shipping fundamentals basically boil down to the balance between seaborne trade growth and fleet growth. Seaborne trade has contracted by about 1% so far in 2022, compared to some exceptionally high levels we recorded during the same period last year. The main developments that we have noticed in 2022 are, first of all, an upsizing in coal shipments. All the sanctions on Russian coal, whether official or unofficial, they have led coal trades to become longer haul. As such, more coal is loaded on bigger ships to benefit from economies of scale. Another very significant development has been strong bauxite exports out of Guinea, mostly to China, a very long-haul trade, as COVID restrictions in China have failed to disrupt aluminium production. What those disruptions did, though, was greatly affect construction activity in China, and we will talk about this in greater detail later on. but it has so far had a severe impact on demand for construction materials, whether that's steel, cement, or metals or aggregates. As a result, we've seen that shipping demand, seaborne trade actually, for the smaller Drybulk carriers, that is Supramaxes and Handysizes, has taken a hit, whereas by contrast, demand for the bigger ships, Capesizes and Panamaxes, still remains strong. Next slide, please. On the supply front, the fleet today is running more efficiently than it used to a few months ago. Congestion has come down by 20% on average from the peaks reached in early 2022. And as a result, fleet availability has increased as more tonnage has come back to the market. This is very evident if we look at fleet growth. Fleet growth so far this year stands at 2.2%. However, if we account for the easing of congestion, that figure is actually double. It's over 4%. The impact of the easing of congestion is more pronounced in the bigger segments, that is Panamaxes and Capesizes. So we're at the point where the bigger segments, Capesizes and Panamaxes, have taken a greater hit from easing of congestion. However, the smaller segments have taken a greater hit from softer demand. Next slide, please. But it's not just about the fundamentals. Sentiment has also turned more sour recently, mostly because of all the macroeconomical and geopolitical uncertainty that we face in recent quarters. And all of that is reflected in the volatility of FFA contracts across all contracts, all maturities, and all segments. It's also reflected on the volumes traded. We see that the liquidity of the market still remains at the record levels that were reached last year. Next slide, please. What about the outlook for the year ahead? Next slide, please. A global economic slowdown is a major worry. We live at a time of soaring energy prices and high inflation and lower consumer confidence. And all of that weighs very heavily on industrial demand and, in turn, manufacturing activity. What this heat map shows is manufacturing activity for each region shown on the right. The greener the box, the more has manufacturing activity improved compared to the month before. Red indicates deterioration and gray indicates stagnation. And as you can see, the table has turned a lot less green recently. And the thing is that manufacturing activity is very highly correlated with earnings for geared ships, that is the small Drybulk carriers, Supramaxes and Handysizes. So over the next year, we would expect some further pressure on the back of a weaker macroeconomic environment. Next slide, please. Looking at China, which is admittedly the largest driver for the Drybulk market, but China's economy is still struggling. And over the past couple of decades, whenever China faced an economic downturn, it typically resorted to stimulus, that is, increasing investment in either property or infrastructure. Property has turned into a systemic headache for China, one that Chinese policymakers have been quite reluctant to address over the past couple of years. Instead, they have switched their focus to infrastructure. And truth be told, they have invested on infrastructure projects at a record pace this year. The reason why we haven't seen all that investment translate into more Drybulk shipping demand like we have in the past is threefold. First of all, China is saturated with all these so-called traditional infrastructure projects, that is railways, highways, new cities. Instead, they have invested more on 5G data centers and water conservation projects and all sorts of renewables projects. which are far less commodity and more specifically far less steel-intensive projects. The second reason is that COVID restrictions reduce the efficacy of any measures taken. And the third reason is that it takes months for all that investment to filter through the real economy and finally generate demand for dry bulk shipping. Next slide, please. So looking at 2023, we would expect some volatility in the short term, especially as long as renewed lockdowns persist and these unprecedented protests in China go on. However, our base case is that construction activity will bottom out in 2023 for three reasons. First of all, although we don't believe that China will abandon zero COVID anytime soon, we do believe that they will ease restrictions, at least in a way that will allow for economic activity to resume with less interruptions going onwards. And even a couple of hours ago, I was reading in the news that they have hinted that we will go ahead with easing these restrictions, especially some quarantine protocols and mass testing requirements in the next few weeks. The second reason is that we've already seen that they've taken the first tangible step in over 10 years to support the property market. That was done a couple of weeks ago, and although it's not enough, that support is not enough to turn the property market completely around, it is a very long-awaited step in the right direction. And finally, all these infrastructure projects that were funded this year will finally enter construction phase in 2023. And this is when we expect them to generate demand for construction-related materials. And the first hint we have when looking at construction activity in China is excavator sales, as you can see on the chart on the left, which have bottomed out in recent months. So bottom line is that next year we do expect a rebound in Chinese construction activity, and with that, greater demand for iron ore and construction-related materials. Next slide, please. Moving on to grain trades, a very hot discussion point in recent months has been the resumption of exports out of the Black Sea. And while that has been great for humanitarian reasons, it has been less so from a shipping standpoint. The reason being that volumes still lag significantly behind volumes we would typically see at this time of the year. For 2023, we don't expect much of an improvement given labor shortages and damages on planting areas and equipment. Another consequence of the energy crisis and the war is an acute fertilizer shortage. Excuse me. Gas is the main feedstock in fertilizer production, and with gas prices rallying since mid-2021, many fertilizer producers had to curtail production and exports. On top of that, Russia is implementing a massive export tax on fertilizers from January 2023 onwards, and we've already seen all these developments have an impact on demand for smaller ship sizes, supramaxes and handysizes that carry the lion's share of fertilizer cargoes. However, there is a silver lining. Next slide, please. In light of the fertilizer shortage, many farmers, especially in Latin America, have turned to less fertilizer-intensive crops, namely soybeans and corn. Brazil alone is estimated to harvest a record soybean crop in Q1 next year that is about 20% higher than the massive crop harvested this year. In terms of volumes, we don't expect that these incremental volumes out of South America will manage to offset the losses out of Ukraine. However, in the shipping world, it's not just about the volumes being moved, it's also about the distance over which they are being moved. And the best indicator for that is ton miles. And in terms of ton miles, we do believe that these incremental exports out of South America next year have the scope to boost grain ton miles back to the very strong levels we saw in 2021. The reason? A recovery in Chinese grain demand. Over the past year and a half, grain demand from China has been quite sluggish. The reason being that the pork industry in China was heavily loss-making. As a result, they had to curtail output. As a result, prices surged, and so did soybean prices, which is the main source for animal feed in China.
Recording stopped.
So China today has an incentive, a very strong one, to import soybeans, process domestically, and sell at record prices. Next slide, please. Another supportive factor for 2023 is coming from coal. Derussifying Europe has become a top priority, and it involves some very extensive trade dislocations. Europe today is sourcing more coal from further afield, whether that's South Africa, the US, or even Australia. And this has greatly benefited the bigger ships, Panamaxes and Capesizes. However, Russia is now sending about 40-45% of its coal to China, up from 20-25% before the war. And that has greatly benefited the smaller sizes, particularly Supramaxes, as Russia is maximizing exports out of the Pacific. The market is currently pricing a 3-year period, 2 or 3 year period of this very strong coal demand continuing, as coal is said to remain the most reliable and economically viable option for power generation throughout that period. Next slide, please. These are the main demand drivers for 2023. Looking at the supply side of the equation, the delivery schedule for next year looks quite manageable, pretty much flat compared to 2022 across the board. Under different circumstances, such a number of deliveries could significantly tighten the market. But as discussed earlier, the demand next year faces certain headwinds. So instead of significantly tightening the market, a low number of deliveries will instead help cap losses and help the market eventually stabilize at a higher level than it would otherwise. Next slide, please. And finally, from January next year, 2 new environmental regulations are coming online. Those are the EXI and the CII. I won't get very technical about them. Just in short, these regulations aim at making existing ships as energy efficient as their new building counterparts. CII is the most challenging one of the two. And the thing with CII is that it's more flexible during the initial stages of its implementation, meaning that most ships will manage to comply just by reducing their sailing speeds. However, given the surge in bunker prices this year and a weaker freight environment, Drybulk ships have already reduced their sailing speeds, and they are already slow steaming. So while we do expect operational changes from January onwards, we don't expect fleet availability to tighten next year on the back of these regulations, because the fleet is already slow steaming. Next slide. What about the outlook from 2024 onwards? Next slide. We revert back to these regulations, and as we mentioned, CII becomes progressively stricter as we move to 2025-26. meaning that even ships that initially comply with these regulations may not manage to come 25-26. Looking at the Drybulk segment, it consists of primarily older and less efficient designs. The average age of the Drybulk fleet is about 12 years. Next slide, please. And as a result, we believe that demolition activity will rise progressively as we move closer to these dates. Suffice to say that about 9% of the fleet that is across the board is above the age of 20 and is facing immediate scrapping pressure, whereas just 7% of the fleet is currently on order, meaning that the order book does not meet fleet replacement needs. Another 12% of the fleet is currently between the ages of 15 and 19, meaning that even those ships may come under pressure ahead of time in light of these stricter environmental regulations. So we believe that a small order book and increased demolition activity are paving the way for a prolonged period of low fleet growth. Over the next 4 years, we believe that the Drybulk fleet will grow on average by 1.5% each year. That compares to 3.3% over the past decade. And there are certain segments like the cape sizes and the handy sizes that will see fleet growth dropping even below 1% each year out to 2026. Next slide, please. But it's not just about the supply side. The demand landscape is also changing. We mentioned earlier that we don't believe that China will revert back to excessive stimulus. The reason being that stimulus equals higher debt accumulation, and Chinese debt is already off the charts. Instead, we believe that China's policy now, from now onwards will be far less aggressive and more targeted. In the words of the Chinese president a couple of months ago, growth will no longer be the sole aim of the Communist Party going onwards. Instead, China has long aspired to shift away from an investment-led economy to a consumption-led economy, and that greater reliance on services and advanced manufacturing. In terms of shipping demand, that means greater requirements for metals and minerals and steels and cement in order to develop all these projects. And as a result, we believe that China's import growth will be skewed towards the geared ships, supramaxes and handy sizes in the next few years. Apologies. I am recovering from COVID, so apologies for that.
That's fine. I'm pretty sure everybody has been through the situation. Let me give you a break here just to get a breath. And before you finish with the slides, I think like one thing that was striking to me as I was watching your presentation was that, you know, as you look at 2021, where was the year that basically, you know, all the types of ships average around 30,000, which was, you know, almost a decade high at that point. It took a massive amount of congestion and inefficiencies in order to tighten basically the supply side. And I think like, as you look at your slides going forward, I wonder what will it take for the next several years to get back to this type of demand and supply balance, meaning that, the fleet is growing much slower, as you said, like maybe cape sizes are below 1%, and maybe the EXI will bring some slow steaming, but we still need obviously a significant growth on the demand side before we get to, you know, to the similar tightness. So How do you see that playing out, several years out? I imagine that next year is not going to be the year, probably, the way we see it. Who knows? Obviously, last year everybody was predicting that 2022 would be strong again, but it didn't happen. But do you foresee, 2, 3, 4 years down the road, based on what we know today? And obviously that's a very long time, but a similar tightening in terms of utilization that can get us to that level. And obviously the futures market is nowhere close to that. Obviously, if you look at the Capesize futures curve, is down to 12,000 or something for the next several years. So clearly the market is not really pricing any such scenario. But is there a scenario that you think that that can play out? You better?
Hopefully.
Yeah.
Well, if we move to the next slide, that's actually what we wanted to lay out. Truth is that we live in a post-pandemic world, and through an economic war that's challenging the inflationary pressures of the past decade. And that's the reason why we have identified 4 things that should define industrial policy in the years ahead. Of course, it's not going to happen overnight. None of these things that we'll talk about over the next few minutes. However, those are the main drivers for the next 5 to 10 years. First one is rearming. And in light of the war, a lot of countries have pledged to boost their military budgets. However, rearming is not just about that. It also involves strategic infrastructure investments. Apologies. Like the $600 billion pledged to counter China's Belt and Road Initiative, or the $700 billion pledged to rebuild Ukraine. And rebuilding Ukraine will be incredibly beneficial for Drybulk shipping, as the whole steel industry of Ukraine has been effectively destroyed. And as a result, all of their steel requirements will have to be met via the import market. The second development is restocking. The world is currently short of most commodities, and especially grains. Grain inventories have been drawn down after the pandemic, and they haven't managed to be replenished since. Same for coal. But we do believe that when normality resumes, extensive grain restocking is imperative. The third theme is restructuring supply chains, which is very much needed, as we saw them fail royally after the pandemic broke out. And restructuring supply chains doesn't just entail reshoring, that is transferring business operations back home. More realistically, it involves holding more inventories and establishing alternative trade networks. But establishing alternative trade networks means relying on less streamlined trade channels, and that means less efficient trade. It also means that we might see greater need for more infrastructure, whether that's terminals or storage facilities. And the final thing that we have identified is rewiring the electric grid. Despite the setback of the war, governments still remain committed to the energy transition, and currently the green infrastructure pipeline exceeds $500 billion globally, and that just includes approved projects. And all of these projects require all sorts of construction materials, steel, iron ore, minerals, metals, in order to be developed. For cement alone, the IEA estimates that over the next 5 years, demand will increase by 10 to 12% just on the back of these projects. So, as you mentioned, next slide, please. Next one. 2023, we do believe that it will be a volatile year, especially the first half, as the market is still trying to rebalance after 2 extraordinary years, which is always an unnerving process, especially when there's so much uncertainty, macroeconomic and geopolitical. But eventually, we do believe that the market will stabilize at a higher level than we've been accustomed to over the past decade, obviously barring the past couple of years. And that is because we still have some very supportive factors. That is very favorable supply side, strong coal demand, longer haul grain trades that can to a certain extent offset losses from a weaker economic environment in 2023. We're more optimistic about the prospects of the sector from 2024 onwards, on the back of these high-level developments that we discussed, which are not only commodity intensive, but they're also, and maybe more importantly, insensitive to interest rate hikes, meaning that we will have to go ahead. And at the same time, we are facing the most favorable supply side in a couple of decades. And it's not just about the order book not meeting fleet replacement needs, but it's also about these fresh environmental regulations coming in that will eventually take a bite and significantly tighten the Drybulk market.
All right. I guess, of course, that makes a lot of sense. And I think that's kind of what a lot of people are seeing today in Drybulk. So thank you very much, Alexandra. And thank you for being so brave. I'm sure a lot of people have been through COVID, and I'm sure they appreciate what you did today. And we hope we feel better. And we'll be back with our next segment, our Drybulk panel of the day, in 15 short seconds. Thank you. Welcome back. Our first panel of the day also contains some of the day's leading voices in Drybulk space, and that, similar to Alexandra, also receive and process first-hand information, and thus can speak about their views and outlook for the Drybulk shipping market as they see it from their respective positions. So today, for our Drybulk panel, we're very excited to be joined by Liz Gao, who is a senior research analyst at S&P Global, and is joining us from Singapore. Lora Iakovidi, who is a senior analyst at Sea Transport Maritime and joining us today from Monaco. Wilson Wirawan, Drybulk team lead at BRS Group, who is joining us from Singapore. And Jeff Landsberg, the president of Commodore Research and Consultancy, joining us today from San Francisco. So I'm going to jump straight into our discussion. And my first question is for Liz. And I think like this time last year when we did this conference, the consensus view was that 2022 was going to be another strong year for Drybulk. People were talking about strong demand. Obviously, we had a terrible war that happened this year, started this year. But in general, I think the expectations was that this year was going to be as strong as 2021, and yet it didn't. So I don't want to look and talk too much about the past, but can you maybe provide us what you think were the reasons why this year ended up being much weaker than expected? Please.
All right, thank you so much, John, for having me today. Hello, everyone. This is Litz. I think this year, just so many unexpected things happened in 2022, I can say. Because, back to earlier this year, there was a Winter Olympic Games in China, if you remember. So there was a steep curbs before and during the Winter Olympic Games, just to ensure that, Beijing will have a blue sky in February. So when everyone was expecting the market will finally recover from this kind of disruption, because iron ore demand were somehow affected, considering at that time, if you remember, China's GDP growth for this year was 5.5%. So I cannot say we're bullish at that time, but at least everyone was holding an optimistic view towards the entire dry bulk shipping market in the early stage of 2022. But all of a sudden, there is a geopolitical tension between Russia and Ukraine. So this kind of, war caused a very severe energy, crisis in Europe, which somehow push up the consumer price inflation. So the central banks of the, let's say, emerging countries and also developed countries are tightening their monetary policy to control this kind of inflation. And then it caused a very, how can I address this, very severe negative impact to the entire dry bulk shipping market. And right after that, in the following quarter, if you remember, there was a massive lockdown in China, especially in Shanghai, and also some other major cities in China. I was in China at that time, and I can assure you that lockdown basically means slow down the economic growth. Because, whatever the industrial production, the construction, the service sector, everything is disrupted. Because lockdown means you cannot go out of your home. You have to stay indoor. So that's why sitting in December, let's look back to the entire year, the GDP growth should be about 3 point something, I think. It's quite low compared with the initial target of 5.5. In the next quarter, in Q3, traditional Black Sea grain season was also disrupted because of the ongoing war. So what I can say is that so many unexpected things happened this year that the market goes beyond the merely fundamental demand and supply balance, right? And that's basically the reason why, the performance of 2022 is weaker than expected.
All right. I mean, exactly. That makes a lot of sense. And I think, obviously, whoever follows the markets have seen all these events unfolding in a very rapid way. So again, let's focus on the future now and see what everybody thinks. And I will start with Lora here. 2023 in a month, and obviously the market, the dry bulk market, is not very optimistic. What is your big thought on 2023? And again, we're going to go back to projections later, but as you see 2023, what are the key events that you think are going to affect the dry bulk market going forward, Lora?
So I think for 2023, which is just around the corner, we see China is probably going to start reopening, and they're going to start easing COVID restrictions, as we've slowly started to see. As China opens up, we'll probably see economic activity pick up, and that means steel production likely to pick up again, coal demand coming back in. We'll see energy commodities come back into play. As we've seen the energy crisis, this is probably going to continue. And we also see a limited amount of new ships coming in. The order book is extremely low going into next year, and these new regulations are going to mean more scrapping. So we're fairly optimistic going into next year, even though there are, let's say, some headwinds. But on the fleet side, the supply is very limited, and this will be one of the biggest factors going into next year and making us, I would say, bullish. So yeah, that's let's say our view going into 2023.
All right. I'll go to Wilson, and again, big picture 2023. As you look at next year, what are the key events or key metrics that you're looking, and what are your thoughts for next year? Wilson, I don't think we can hear you. All right, let me go.
Can you hear me?
Yeah, now I can hear you.
Oh, sorry about it.
All
So
right.
thank you for inviting me. So regards to 2023 outlook, this is how we look at it. If the C5TC, the index that tracked the Capesize average daily earnings, would disappoint in 2023, it will have a drag down effect on the smaller size vessel rates. So as a realist, until the winter in China is over, we believe that the relaxation over COVID measures is likely to be selective and inconsistent, even considering today's development in Guangzhou. Hence, we still remain slightly cautious to not view these piecemeal developments as guaranteed signs of breaking away from the zero COVID policy. Because if political agendas necessitates the need to tighten measures, the likelihood it might happen again, especially when the Chinese people did not achieve herd immunity. And we believe that the lesson learned in Q2 this year during the Shanghai lockdown should not be wasted. And in our view, only when we see the complete removal across the whole country of the following items, then we'll be able to revise our assumptions in a more constructive manner. First would be the removal of the health code, which serves as an entrance pass to workplace, restaurant, transport, and most public buildings, mandatory PCR testing, and of course, the building of new quarantine sites and makeshift hospitals. And that's the case for China. And if we move away from China and looking at the global picture, the number one headwind would definitely be inflation. And because it's tricky, because once the inflation genie is out of the bottle, it's not really easy to pick it back. So back in 1979, when the Fed fund rates were pushed to 20%, a whooping 5% above the previous peak inflation, it's the equivalent of today's Fed embracing double-digit rates. And even then, it took quite a long time, close to over 6 years, to bring down the inflation to the 2% official target. Hence, the global economic outlook for 2023, reasonably speaking, in our view, does not look that optimistic. And meantime, it's not just monetary tightening. Fiscal austerity by governments also need to be implemented in tandem. Hence, one credible scenario that I could envision that next year freight could be better than this year would be trade patterns for all types of dry bulk commodities experiencing massive disruption, probably due to geopolitical tensions that would then increase the average distance to an extent that could more than offset the downside risk of an economic slowdown. So this is a similar situation that's currently happening in the crude and product tankers market, but that is also a big if. And another one, which is also previously mentioned, would be Ukraine winning the war, and with Russia accepting Ukrainian terms, and the rebuilding of the destroyed cities and infrastructure would provide a massive boost, not just in volumes, but also in trade patterns. Yeah.
All right, and that's very helpful. And we're gonna focus a little bit later on China, and I guess you're much closer to what's going on in that part of the world. But let me jump to Jeff and see what big picture you think about next year, Jeff. How do you view the dry bulk market next year? In the summary.
Yeah, so actually just this week I've become much more bullish for dry bulk for 2023. But a big reason is because of China. What we've seen the last several days, while not widespread, has very much been synchronized protests and even riots in China, to the point where China's central government is finally, at least in my view, signaling that they are going to significantly ease. I mean, for months I've been telling my readers that the market has been getting too bullish, too optimistic, but I really think that this week things have actually suddenly changed. And that's because the Chinese economy is doing so poorly that the government really at this point has no choice but to significantly ease. And again, I think the government has been signaling that. What's been super important to me is that the last 2 months has seen inflation in China come in hotter than retail sales in China. That's almost unprecedented. I'm actually going to be writing about this in my next weekly China report. But what's really significant is that throughout this century, there's only been 2 periods where inflation for at least 2 months was stronger than retail sales, which is just consumer spending growth. Those previous 2 periods was back when China's COVID outbreak started in January 2020. And much later, from March to May of this year, there was another coronavirus surge in China. And so those are 2 periods where you had inflation higher than retail sales. But finally, September, October of this year, you see inflation higher than retail sales for 2 straight months, which means that Chinese consumers, they're not buying more goods. They're just spending more. And that's a very, very significant sign of economic distress. And then, to me, that's been at the foundation of the protests in China during the last few weeks. Consumers in China are hurting so much that that economic pain, combined with closures and lockdowns, is just too much. It's kind of been a boiling point. And so I think finally the government has no choice but to significantly ease. So I actually do think that we're going to see an acceleration of easing, more than the market expects. And I think for the dry bulk market, that's really going to help. I think the Chinese economy is going to surprise on the upside next year. And so I think that will finally be more of an engine of growth in the dry bulk market.
All right. Now, I mean, we're going to talk a little bit about China later, but I want to just shift subjects here and obviously go to the ongoing Russia and Ukraine war here and the impact on the dry bulk shipping. And obviously, I think the biggest effect that it has had so far has been on coal trade and coal flows. Now, energy security has been driving coal volumes to Europe, but it seems that this trend has come down a bit. The weather in Europe is quite mild. Inventories look adequate for the winter. So I want to ask you a little bit about this coal trade, and I will ask first Lora and then Wilson. How important you think that's going to be in 2023, the coal trade? And, you know, historically, dry bulk has been about coal. Obviously, iron ore is the big trade here, but without coal, it seems that things cannot really progress. Do you think that is accurate, Lora? Do you think that coal is significantly important next year?
I think definitely, as this year energy commodities came into focus, this is a trend we'll probably continue to see into next year. Coal is almost as big as iron ore in terms of trade volumes. There's over 1 billion tons of coal traded on the market. We've seen a major shift in the coal trade this year. For example, Russia has been a traditional coal exporter to Europe. This year, because the Europeans banned coal from Russia, and instead they bought more from South Africa. Instead, we've seen the Russian coal go into China, which is landborne, and it's cut seaborne volumes. So bad for us, let's say. And we've seen more Russian coal flow into India. But overall, since Europe is restricting coal flows, gas flows from Russia, I think with the energy crisis next year, coal will be a significant driver of the market. We're going to see the larger ships being helped and also the smaller ships being helped by this. So overall, we see coal demand going strong, and particularly in light of the war between Russia and Ukraine. So yes, coal, we see it growing into next year.
Wilson, what do you think? How important is coal for next year? What are your thoughts?
Just to give a bit of recap for this year, many industry participants had rightly opinions since the beginning of the year that with the war, it will fracture the existing coal trade flows, and that in turn lead to longer distances and voyage days in shipping coal. And hence, in theory, a boon for dry freight. And looking at Access Marine data in the first 10 months of this year, despite the total coal volume declining by 0.2%, the total ton days actually improved by a welcoming 6.1%. But it's mainly led by Capesize, Kamsarmax, and Overpanamax, a slightly larger vessel size that ply further destinations. But unfortunately, that's just a part of the picture. We think that coal alone cannot be the sole savior, because if you look at the performance at the other two main dry bulk commodities, there's actually a year-to-date loss in ton days of 5% and 8.1% by iron ore and grain respectively. In particular, grain suffered a loss as China had been less of a driving force this year as compared to last year, when they were building back their state reserve and hog population. So in aggregate terms, the top three commodities suffered a year-on-year decline of ton days of 2.17%. And something that's more worrying from my perspective is that despite international coal prices have soared over the last year, actually coal trade volumes remain quite subdued. Logically speaking, high price should incentivize coal miners to ramp up production. However, all major exporters from Australia in Pacific to, let's say, South Africa and Atlantic have been prevented from raising coal production or exports due to a myriad of reasons. It can be weather disruption, land logistic issues, labor strikes, but also more importantly, a decade long of ESG mandates that really penalize fossil fuel expansion. And in our opinion, if dry bulk is unlikely to fully benefit from this change in coal dynamics, even heading into 2023, if the output ceiling from swing exporters like US, Colombia, and South Africa remain capped. So this is our view.
All right. So let me shift back to China, and I think that has been the focus of most people this year. Obviously, for 2 years, we're focusing in the extraordinary COVID pandemic, but everybody is focusing back on China. And I want to go back to Liz and ask her a little bit about what you think the main drivers that could potentially see a recovery in China are for next year. And I think, like, obviously, discuss a little bit about the COVID situation, how you think this is going to play out over the next several months, but also, I think, broader economic growth, real estate market, demand for steel, and so on. So how do you foresee the economy in China next year, Liz?
Actually, John, to be frankly, when we are talking about China's zero COVID policy or China's economic outlook in next year, this is for sure $1 million question. That not only, the Chinese people who stay in China, they care so much about this, but also like you and me who live outside of China, but we just keep a very close watch on this thing because it means so much to dry bulk shipping, right? So I think you agree with me is that China plays the key role in dry bulk shipping because China is the largest importer of a lot of major commodities. And also at the same time, if we look back to the Q3 of 2021, when the heavy congestion disrupted the market and somehow the freight rate was supported. So China's demand and supply are vital in the dry bulk shipping industry. So looking ahead in 2023, I actually agree with Jeff that China's gradually softening the quarantine measures that will somehow accelerate China's economic growth and, to drive the iron ore import demand and steel output, so on and so forth. But something I have a different opinion is that, I don't think this will happen before the first quarter of 2023, considering Chinese Lunar New Year is in January of this year. So Chinese Lunar New Year means that people will travel from where they work back to where they live, right? So this kind of Omicron spread will be faster. And also the key thing is that there will be a key political session in March called the Two Sessions in China. So before that, I don't think there will be a very, fast softening measures. But after Q1, I think it will be much better. So the major driving force will come from, the China's GDP rebound in 2023. Yeah.
All right. I want to go back to Jeff, and Jeff, you focus a lot on your research on China, and watching Alexandra's presentation before about long-term growth rates, and obviously the whole debt cycle in China. There is a school of thought that says that actually there is a structural change on the real estate markets in China, and we won't be able to see the previous highs that we saw a few years back. Do you subscribe to this thesis? Do you think that there is some kind of a structural change after the crash in real estate in China?
Yeah, I mean, I do think there's been a structural change, and to me, this is the biggest issue that the Chinese government is facing. Simply put, there's already too many homes, already built homes, and not enough actual demand for these homes. And of course, China continues to urbanize. More and more Chinese citizens continue to rise up to the ranks of the middle class, but China overall is already saturated with homes and housing, and so it's definitely a very significant problem, and it's a huge challenge. One thing that's been significant to me is that in October is the most recent available lending data. In October, Chinese new loans fell to the lowest level in 5 years. That's quite significant, and a big reason why is that when banks issue loans, a lot of the loans are centered around the housing market. But what the Chinese government and what the Chinese banking sector is encountering is that there's only so many lendees to actually provide loans to. So it's hard. So I think that again is why I think that Chinese government really has to end up going just full steam ahead with significant stimulus, in that I think that they have to continue to accelerate urbanization. They have to have economic growth come in stronger and stronger. I think that they're going to, I mean, the Chinese government has not been wanting to further inflate any bubbles in China, but I think if you have one or two choices, to continue to blow a bubble or to have moderate growth, but not enough areas to actually build, I think the Chinese government is going to have to continue to, or is going to have to shift more and to choose to stimulate and allow a bubble of respects to continue to be blown. So I do think that the economic growth is going to surprise on the upside. I think it's desperately needed because it's either that or a sharp landing in China. But I think for at least the next few years, we're going to see some powerful spending and some powerful growth in China.
All right. We're running out of time, but I want to ask Lora and Wilson about China very quickly. What are your thoughts? Lora, what do you think? I mean, is there a recovery coming next year?
I tend to agree with Jeffrey. I've become more optimistic in the last week because we've seen China slowly start to ease these very harsh COVID restrictions. So we're already seeing, for example, them scaling down PCR testing. People can stay at home instead of going to COVID isolation facilities if they're close contact. So we genuinely think that China will slowly start easing these restrictions, and I'd be surprised by the spring of next year if they're not completely, let's say, or almost completely eliminated. And with this, economic activity will restart. People can start going out to entertainment venues, taking airplanes. Heavy industry, will come back on track. I mean, if Europe and the U.S. is anything to go by, we're living with this virus, and our industries are working, schools are open, we're coming to work, we're all back at our offices. So I think now that China is seeing this, and there's even stories of COVID survival stories now going around in China. So I think all this is a stance, a changing stance, let's say, in the government. And I think this year China has not reached its GDP target, is not reaching this 5% that they wanted to reach. So I think next year they're going to be coming with more stimulus, as they've traditionally done when the economy falters. And I think next year will not be that different to other years in the past. So I think we're going to see more stimulus again next year, and probably also targeting the real estate market. I mean, now we're starting to see that steel margins, from being negative over the last few months, are now back in positive territory. So this is all kind of laying the groundwork for, I think, a better China and a better economic growth going into next year. So I'm optimistic, and I think we've started to already see this.
All right. Wilson, quickly, what do you think about China, or from where you sit?
Okay, I think one of the more important impact of China's zero COVID policy this year is actually the breakdown of confidence. First, Chinese consumer confidence. Should I spend more or less? In the event I lost my ability to earn money due to unexpected quarantine measure, and when I'm unable to earn money, I incurred more personal debt. Second would be local companies' confidence. Should I expand production or take in orders but risk losing more when my workers and supplies could not move due to lockdown requirements? And thirdly and lastly, foreign investor confidence, especially in the light of the recent Foxconn labor riots. Is China still worth the trouble to invest? So for me, the more important thing beyond just if in the event that it does relax, is there ability of the government to restore confidence? Because without confidence, which is the most important commodity, even though you can do a lot of stimulus or cutting down the benchmark risks, will there be people willing to risk it, to borrow money to eventually stimulate the economy down the road? But as of now, the black box nature of the zero COVID policy is making harder for shipping people to predict or to rely on past Chinese import patterns to make chartering decisions without being surprised later on. But as we all say, shipping, it's always changes and it's always unpredictable. So it depends on whether you're optimist or a realist.
No, that's absolutely true. And obviously, everybody's focusing back in China after a few years of a lot of distractions globally in obviously geopolitical, COVID, and so on. Okay, so I wanna obviously close this panel with the traditional question about outlook, and I'm not gonna ask for numbers, but today, as we stand, the Capesize futures for 2023 is below 12,000. And what I want to ask quickly is whether you think that number will happen. Do you think it's going to be higher? Do you think it's going to be lower? Do you think the market is too pessimistic? And again, I'm going to use the 12,000 as your benchmark here, and I'm going to go around and ask everyone what they think. So, Liz, do you think Capesize is average above 12,000 next year?
I think so, actually, because, as I mentioned, I'm quite conservative in the start of 2023, let's say in the first quarter. But hopefully we will see some recovery starting from the second half of 2023. Like Alexandra just mentioned, that very steady demand growth in 2023. And the key thing is that from the supply-wise, if you consider all the new buildings, if you consider the demolition, then the supply, the fleet growth will be limited compared with 2022 or 2021. So supply is the key thing that will support the market in 2023. And I'm quite optimistic. I think it will be slightly higher than the FFA assessment now.
All right. Lora, I mean, this time last year, Capesize were 22,000, the futures. We averaged in 16,000 this year. What do you think for next year? 12,000, the futures, higher or lower?
I definitely think 12,000 is too low on the Capesizes. I'm an optimist, but I'm also a realist. I don't think we're going to be at $12,000 per day. I think we will be more in the range of, let's say, 16,000, 17,000. Let's say this is kind of a return to long-term averages. Between 2009 and 2019, the Capesize market averaged about 17,000, 18,000. So I think we're going towards a return to that, about 16,000, I would say. We're very optimistic on the fleet. We're at the lowest order book in God knows when, I think over 20 years. So yeah, we're very optimistic, and these new regulations are definitely going to lead the market to more scrapping. So I'm an optimist.
All right, so about the same like this year, I guess. Wilson, what do you think? 12,000 the right number?
I think I will put it at 14.5K, which is lower than this year 16K that we have seen thus far, but still higher than 2020's 13K. But that said, we believe that it might have the potential to go like 1,000 lower if the China zero COVID policy persists throughout the year, and also if there's some risk of a global economic slowdown due to inflation and interest rate, etc. and etc. But I think as of now, the 12K that we're seeing in the futures market is also due to margin costs, and at the same time now the spot market is so down and pessimistic. It's lacking investors or speculators coming in to buy it up. So definitely from that perspective, I think 12K is a bit low.
All right. And Jeff, what do you think about the futures here? Too pessimistic about Wright?
Yeah, no, I think it's too pessimistic. I would definitely buy 12,000. I would be happy to put a lot of money behind that. Again, to me, everything really changed the last few days in China. I think China really is going to surprise on the upside. Also, so last night there's a Guangzhou tower in China, which is a pretty iconic tower, and it has messaging. It literally said on the tower last night, "We're all individually the first person responsible for our own health." If ever there was the Chinese government waving a flag telling us, we're gonna shift, we're gonna loosen, things are gonna open up, there's a message on the tower. So to me, for the dry bulk market, that message was, hey, by calendar 2023. So I really, again, think China is gonna surprise on the upside, and I think they have no choice, and I think they're signaling to us that it's gonna happen. So a lot of people have waited, and I think now actually finally is a good time to go long.
All right, that's very interesting, and that's great to hear such honest opinions. There is no seller of the 12,000, I guess, and as the saying goes, is it is easy to make predictions, especially about the future. So kudos to our panelists for being quite brave here. And I would like to thank everyone, and especially Wilson and Liz, for staying up late in Singapore for this panel. And it was very interesting to hear different views, and I hope everybody enjoyed. And we're back in 15 seconds with our tanker presentation.
Thank you, John.
Thank you, John.
Welcome back. So our next hour will focus on tankers, and over the past year have seen an explosive move upward as a result of various factors that affecting energy markets. Obviously, the Ukraine war has been the most important one, but it's stunning that looking to last year, where dry bulk has gone through kind of a similar cycle, and we're sitting in December and looking back at the 100,000 Capesize rates. Today, we're looking back at the tanker space, and we're looking at very, very strong rates, probably the strongest they have been in at least a decade in that space. Who can forget, obviously, similar dislocations in the past? In 1967, the Suez Canal closed and for 7 years, and obviously fortunes were made during that period in the tanker market. So I think the question here is that are we in a similar situation? Is that just a spark, or there is something stronger that's going to last for a longer period of time in the tanker space? And again, obviously, we always have to remember that shipping is a cyclical industry, and we should not be fooled by long-term growth in that industry. But it's important to see whether that was just a 6-month spark or there is more that's coming. So now with Natu, we're going to introduce our next segment that focuses on the current state of the tanker market as well as the outlook for next year. And we're very excited to have with us our next presenter that over time has provided some very accurate predictions about the tanker market outlook, and especially this past year. As the global head of freight for Argus Media, Alex Younevitch has been leading voice in the tanker market with very timely research and forecasts with more than 15 years of experience in the shipping markets. So Alex has faced similar cycles in the past and can provide us a lot of color on what lies ahead for the current cycle and how this cycle will progress. So joining us now live from London, Alex will provide us with his view and outlook for the tanker market. Hi, Alex, and good afternoon from New York, and the floor is yours. Please go ahead with your presentation.
Hey, John, thank you very much for this, and hello to everyone. Now, I might break the system here, but I'll try to share my screen because the whole next slide thing never quite worked for me. Hopefully you guys can see this.
Yep, I think
everyone sees the screen? Yeah.
Yep.
Great. All right, so just as John already did a little bit of a spoiler here, the tankers have been performing admirably, we can say recently, and we're talking both in the crude freight and products freight, right? So we actually have seen the levels which some people might call record-breaking or unprecedented, seems to be the popular word every time something happens, right? But obviously we've seen high spikes and high lows before. Right, and what is quite special about this particular case is that what we had here in 2020, when we had the increase of the floating storage on both sides, when the pandemic really hit, and everyone thought that was the end of the world, that we'll never see prices like this for a while again, and for a while they were right. And now we're back into this, and all it took is obviously a land war in Europe. Yeah, so no big surprise there, and yet another geopolitical shock. Now, in terms of why these prices behaved the way they did, and in terms of where it's going, there are quite a few concepts which need to be understood here in shipping, and to understand where it might go from here, right? One thing, and the first important thing to know about any freight, and that's mostly for people who maybe are not in this market or generally not looking into it that often, is that in the end of the day, expensive freight means that it's more expensive to move whichever commodity it is, in this particular case, crude or products, from point A to point B, right? And that means that certain crude grades or certain producers of products might become more or less competitive, and the flows on specific trade routes may change with it. So freight is an inescapable and integral part of the commodity trade, right? It's the same as for, let's say, your personal travel and anywhere, right? You might have the most amazing holiday book, but if your transportation costs are way too expensive, you might consider something different to do with your time. Right, so freight is always there, and it's always there influencing the market. Having said that, with these high freight rates, which we have seen recently, and with the drop in the fuel oil prices, which always follow the oil prices. So as oil price deteriorates, that means that the marine fuels become cheaper, and that means that it's cheaper for ships again to go from A to B in terms of their expenses. And with that, we have seen the tanker earnings, how much each of the vessels earns per day, soar to quite fruity levels. Yeah, so owners have been making a lot of money, brokers have been making a lot of money, and surprisingly, quite a few charterers potentially made a lot of money as well, simply because they either wearing two hats and running their own fleets, or just because they might have been hedging it quite well, right? So any kind of volatility really brings a lot of money, but nothing as much as when the market increases. And that's an important piece to remember for later in this deck, is that ship owners did earn quite a bit of money this year. And one inescapable fact that we always know is that when ship owners have money under their mattress, they tend to invest it as soon and invested heavily in generally in the new ships as soon as the time is right, or they believe the time is right. So that's worth remembering straight away. And another important fact is that we have this increase in earnings across the vessel sizes, across all clean and dirty tankers, in some segments more, in some segments less. Now, why the rates went up? Obviously, the volumes have been increasing, and I'm sure we have, I think, a speaker here from Vortexa on the panel, so they'll probably talk much more about it. But generally, we've seen more volumes recently moving seaborne, both for crude and products around the world. And one of this is the factors is the increase in demand as the demand recovered after the pandemic, and with that, or obviously you have just more pure volume hitting the water, and as you have more volume, you obviously have more cargoes, that is more demand. But one thing which is often misunderstood about shipping and the demand in shipping is that it's not just about the volume, it's not just about how many cargoes you put on the water, it's also about the distance on which you move them, right? So the longer is the distance, on which you move every particular cargo, the higher is the demand. This is something which is called ton-mile demand. This is the true representation of demand in shipping, which means that if you move the same cargo on a longer distance, it provides more demand simply because that vessel which is carrying this cargo won't be available for any other business for a longer period of time. And within the ton-mile demand, or the changes in ton-mile demand, specifically in the change of distance, lies one of the key factors of why the tanker freight has been going up recently. You see, with the conflict in Ukraine, and obviously the shunning of the Russian oil and Russian products, two main factors happen. One is that Russia had to start looking for alternative buyers from their, let's say, most one of the biggest buyers before, which is Europe, and try to send it to other buyers which are mostly further removed. And at the same time, Europe had to displace the Russian barrels and Russian products with something else, again, usually from further afield. And the difference in what it makes for demand is quite large. So, for instance, here we're looking at the Urals crude, which is one of the pretty much the Russian grade here, or like one of the one which is Russia most known for and with the largest volumes, and their main export routes up until the conflict broke down in Ukraine was going from the Baltic to Northwest Europe, or from Baltic to Mediterranean, or from Black Sea to Mediterranean, or basically on quite a short haul routes, with some again going further afield. Now, if we consider that now with Russian crude being much less desirable in Europe for now, for the next few days, in a few days it's basically going to be banned. What has been happening is that we've had other crudes, for instance, WTI or Basra Medium and others, displacing the Russian volumes, and at the same time, the Russian cruise has been going on longer distances to places like India, to places like Asia Pacific. And if we, for instance, compare how much just the Basra crude going to Northwest Europe provides against Urals going to Northwest Europe, that is roughly 3 times more demand. From every single cargo that you send into Europe from Middle East instead of the Baltic, that is 3 times more demand for tankers. More demand, higher prices, obviously. And then at the same time, you got, again, WTI going on longer distances, you get West African crude going on longer distances, and so on. All of this bulks up the rates. And the important thing to understand here, again, is that there is a very high incentive in terms of just pure money, the green cash, so to speak, in just taking the Russian crudes, right? Whether it's being shunned, whether it's being banned, and so on. So we are talking about a massive spread, which ranges from, let's say around $30 per barrel between the Urals crude and the crudes like, basically the alternative crudes which are there available for European buyers, or generally the buyers around the world. And here you can see the comparison between the Basra Medium and Urals going to West Coast India. And on the graph, you would see that both the freight and the price of crude. And there's a huge difference between the price of crude and the huge difference between the price for freight. So the freight is much more expensive to move Basra Medium to West Coast India. It's like staggeringly more expensive. But since there is such a huge difference in the crude price, it doesn't really make a dent anyway. So the flows have been generally strong. Now, what it also means, apart from the fact that there is a high price incentive, the price of the commodity has been considerably higher as well. So for any of those longer haul trade routes for displacing crude or products, the importance of freight has become much more important. And for instance, when we're talking about displacing Russian crude in Europe, when say someone like WTI compares or US Gulf exporters competes with Middle East or West Africa, small fluctuations in freight can actually mean and here is another piece of that point is that even with the freight accounted for, if you compare the delivered price of crude between Urals and let's say Basra Medium going to India, even with all of that accounted for, you have massive incentive for certain buyers who are willing to live with the risk and let's say there is a huge incentive for them to do so simply because the price difference is so large. And yeah, like I said, you'll have other crudes going on longer distances as well as the market reshuffles, because it's none of those markets live in silos. They're all interconnected. So as you send more of the specific crude to a certain buyer, that means that that takes the share of that crude or production from a different buyer, which will again have to displace it. The crude slates for different refineries will change, the behavior of different buyers will change, and the freight on all those routes would again be affected. And all in all, what that means is that right now, as we sit here today, there is a very good chance that going forward in the short term, we'll see crude still moving on longer distances around the world, simply because we still have the Russian ban on Russian crude going on, because the displacement of the barrels isn't going anywhere, and so far, for now, we do have the strong demand going above the pre-pandemic levels. Now, the very similar thing is going on for the diesel market as well. In fact, it's quite a bit worse when it comes to the diesel market, because unlike for crude, it's quite hard to displace Russian diesel in Europe. Because they've been taking so much of it, but the situation is quite similar. You have to displace it, while the the complete European ban for diesel isn't coming until the 5th of February. The European buyers are already buying diesel from further afield, so from places like Middle East and India, for instance. That's where the increasing volumes started coming in. And of course, they've been buying the Russian diesel while they can, like crazy, recently, just because this is the last chance to do so. But again, as the ban comes in, you will have diesel going on much longer distances, and even if the volume was to remain the same,
All right, I think we lost Alex. All right. Well, I guess then we can just move to our tanker panel. I see everybody ready, so let's take a 15-second break and then move to our tanker panel. Alex's presentation, obviously geopolitics have played a major role this year on the tanker market, and I think that probably is what everybody who is investing in this market is focusing on. It's not so much a traditional supply and demand drivers, but probably is what happens globally, especially with the war in Ukraine and Russia, and how this is going to play out over the next months, maybe years. So to that extent, we have a great panel with us that's going to discuss about all these developments and where do they see the tanker market going forward. And for that, I'm going to go to Athens to my colleague Thanos, who is going to moderate the next panel on tankers. So Thanos, good afternoon from New York. Take it over.
Thank you, John. The global oil market is about to enter a new phase of uncharted territory, characterized by significant supply and demand-side risks. We are glad to have with us people focusing on one of the most important elements of the oil sector that will provide us with their views on the current state of the tanker market and give us their outlook for next year. We are joined by 4 distinguished guests who have followed the tankers market for many years and on a daily basis are focused on every aspect of it. Our panel today includes Maria Bertzeletou, market analyst at the Signal Group, joining us from Athens, Edward Finley-Richardson, shipping investor, joining us from Paris, Dylan Simpson, freight analyst at Vortexa, joining from London, and Matthew Wright, senior freight analyst at Kpler, also joining from London. So let's get started. Oil demand still has some upside, and although growth rates risk being revised lower, ton miles are growing, and high gas prices have encouraged a switch from gas to oil in power generation. Some analysts believe that these factors combined with low fleet growth should be enough to sustain and perhaps even improve tanker markets into 2023. The question is, and we will go around to ask the same to everyone here, what is the current health of crude freight markets and what lies ahead for them going forward into 2023? First to Maria. Maria?
Thank you, Thanos. As mentioned before, geopolitical uncertainty of Russian oil supplies and a shift in trade flows to Asia increased demand for crude oil tonnage and pushed freight rates to exceptionally high levels in the second and third quarters of this year. November saw a downward trend in VLCC rates as a wave of Chinese COVID cases and a new set of restrictive measures weakened crude demand. It looks like the fourth quarter of the year will also end with a downward trend in VLCC rates. The challenge for VLCC vessels is the enforcement of the European ban on Russian oil imports as crude flows from the Russian Federation to Europe are replaced by oil from the United States and the Middle East to Asia. So this has reduced demand for VLCC vessels, but increased significantly demand for the smaller Suezmax tankers. In parallel, we see a trend of Russian oil exports from Black Sea and the Baltic Sea ports to Asia being replaced by oil exports from the United States, and this depressed further demand for VLCC vessels. It must be said, however, that demand for VLCC in terms of ton days and miles is still significantly higher than in the previous 2 years, and this fuels positive expectations for VLCC freight revenues in the days ahead. It is interesting to note that the upturn of freight rates observed during the last quarter continues to be reflected in the upward trend in vessel speed. So the current speed figures have exceeded the levels of the previous 2 years and are now the highest level since the beginning of this year. So it is the macroeconomic challenges that are shaking up the future of VLCCs and crude oil freight rates. It remains to be seen how oil supply will evolve in the remaining months, given the current growth in oil demand and the response of European economies to the impact of Russian oil sanctions in December.
Thanks, Maria. Ed, what are your thoughts? How do you view 2023, and what are the differences that will make it stronger or weaker than the past year?
Hi, everybody. Well, I think that Maria covered a lot of really important ground. And of course, we just went through such a terrible year in 2021 that the recovery from that was largely the story for this year. I think there's part of the story is very clear, which is the supply side, of course, as usual. But because we are experiencing trade disruptions that we haven't seen before, it's really unclear what the future holds. I think it's clear that we have a much higher baseline to expect from this year. It's easy to remember that VLCC rates earlier this year were still below operating expenses at something like 12,500 per day in Q1 and Q2. They started recovering a little bit in Q3. Suezmax and Aframaxes, of course, benefited from the changes much earlier. And I think that the key will be higher utilization. I think that we've seen a lot of lightering and ship-to-ship transfers to allow people to obscure the trade which is going on. I expect that we'll see a lot more of that. I expect people to cheat with respect to the European price cap to get the Russian oil to flow, which is the way that trade always works. I think it's easy to model things and to have expectations with respect to what is legal and what's not, but there's a big gray area there. We've already observed that off the coast of Portugal, near the Canary Islands, near Greece. Of course, it's been well documented by journalists everywhere. So anyway, coming back to the question, that it's been kind of ironic to listen to CEOs on earnings calls talk about the fact that the most important thing was the supply, which is already very tight, and that the war was actually not the cause of this huge change in rates. But I think it's clear to all the market participants, anyone involved in shipping, that as long as there's a bifurcation of trade between those who are willing to buy Russian oil and those who aren't, distances are going to improve, or rather lengthen. And my expectation is at least a baseline of double average rates. So to be more specific, this year, if we average the terrible Q1, Q2 for VLCCs, we come out to something like 28,000 per year per day. And next year, I expect something like 50, 55 average. So I think there'll be ups and downs, but it's going to be much, much better than 2022.
Thanks, Ed. Dylan, to you. What are your thoughts, again, on your outlook for 23 versus last year?
Thank you, Thanos. Yes, I think we've touched on some very important points here, and I'd like to echo some of them. I'd like to think of the year of 2022 as a year where we saw lots of transformation. We've seen lots of reshuffling due to the conflict in Russia and Ukraine, and we've also seen some looming effects of the COVID-19 pandemic, with recessionary fears threatening demand, and also some uncertainty around the participation of China. Certainly what we have seen, though, is an upward trend in crude tanker demand, and that's derived from volumes, which Alex touched on in his presentation. So for crude volumes, what we have seen is an upward trajectory since the pandemic, and we are still about 1 million barrels per day below the loadings levels from pre-pandemic times. So there is still room for growth in this market, and there has been a general trajectory upwards, which has converted into tanker demand. So, and with that, which we will touch on later, there's also this supply issue of tankers being really occupied and a high utilization rate within the fleet. And so that's all very supportive for rates. And what I would say is that tankers seem to have been postured in a very strong position heading into 2023. And they certainly do have the momentum to carry on and soar higher. But we know that 2023 will bring many risks. And that's why I like to think of 2023 as the year of adaptation. So we will see a lot more different opportunities in terms of logistics and trade patterns for tankers. And also Ed touched on it a little bit as well, with the increased need for STS transfers as well. These will be sort of some of the newer, more frequent opportunities that we could see for VLCCs, especially. And yes, so with that, we have a strong position going in, but there are many risks that could definitely cause a little bit of hesitation, or even some softening in the crude tanker market.
Thank you, Dylan. Matt, what do you foresee 23 will bring versus 22?
Yeah, thank you very much, and thanks for having me. Yeah, I would echo a lot of the points that have been made already. So if just looking at the current market, I agree, it's obviously been very strong, and the trigger, as Ed said, was the Russian invasion. Absolutely. It's easy to forget that at the beginning of the year, rates were close to break-even levels, and were for much of the prior 18 months. But here we are now, and just 2 weeks ago, rates for VLCCs from the Middle East to China were $3.50 a barrel, and from an owner's perspective, earnings were over $100,000 a day. for the first time in 2 years. In terms of what's been driving this, the Middle East accounts for the bulk of VLCC demand. But in the last few months, most of the growth in ton miles, which was creating the tightness in rates, has come from the Atlantic Basin, predominantly the US and Brazil. Just last month, the largest increase month on month in ton miles was for VLCCs was from Brazil. So there's a huge, shifting what's going on. Such as the tightness in vessel supply that we're seeing just massive volatility in rates, with rates jumping sharply from increases in exports or short-term supply shortages in vessel supply. This has been evident in Aframaxes and Suezmaxes, looking at, in the Black Sea and the Caribbean. So looking ahead, we haven't talked a lot about China yet. On the dry bulk segment, it was very heavily on China. And I think China is going to be a huge factor. So crude exports to China account for about 30 to 40% of dirty tanker ton miles, and it's closer to 50% for the largest carriers, VLCCs. So China's crude demand outlook is fundamental importance to the tanker market next year. The zero COVID policy in China has massively limited demand over the last few years. So there is considerable upside potential to crude oil imports should restrictions be limited. But, in my view and our view at Kpler, we think the relaxing of these rules is going to sort of drag out. It's definitely going to happen, but I wouldn't expect any sort of sudden increase from China. We'll turn to a bit more detail on Russia shortly, but as we've sort of heard people mention already, the reshuffle in flows from the EU ban is expected to be quite constructive of tanker demand, in my opinion. But there are bearish factors at play. OPEC output dropped 550,000 barrels per day last month, and this will continue to feed through into exports over the next few months. And in addition, we've got new refinery capacity additions in the Middle East, which will reduce export availability. On the demand side, overall, I think the recession risk to tanker demand will only begin to be seen sort of later next year. But there are supportive factors that could outweigh it. Looking at the vessel order book, we should see, it's very weak. This should keep supply growth down, especially if scrapping remains low.
Thank you. Thank you, Matt. That was very insightful. I would like now to move to a subject that is in everyone's mind and actually build on what Matt just mentioned. European Union's ban on Russian oil. How big is Europe's crude dependency on Russia? Which countries are stepping up to pick up the slack in Russia's fuel oil supply? Matt, I turn to you for this one again.
Yeah, thanks, Thanos. So yes, we're 4 days away from the EU crude import ban. EU seaborne crude imports from Russia have steadily declined over the last few months ahead of this deadline. And in November, EU imports from Russia were 670,000 barrels a day, or 6% of total EU crude imports. This is down from 1.5 million barrels a day last year, which was around 18%. So we've definitely seen a decline, but this needs to drop. Now, bear in mind, it's not going to drop to zero, as there are exemptions for Romania, Bulgaria, but most of that remaining 670,000 barrels a day will stop. In terms of which countries are going to step in to take what previously went to Europe, we think it will be mostly countries that have already ramped up imports from Russia. Alex covered a lot of this in his presentation. So India, China, but also Turkey. And then there's also potentially smaller volumes to other countries such as Pakistan and Indonesia. As I've said, Europe has already replaced a lot of its crude that it previously took from Russia. And we expect the remainder to sort of come through increases from the US, West Africa, Latin America, and the Middle East. And sort of that's where it's going to build out from. The changes in flows are expected to, from these shifts, are expected to produce an additional lift to dirty tanker demand. So we estimate that the effect on ton miles from the longer voyages from Russia and those to Europe could increase dirty tanker demand by around 2% in the first quarter of next year, compared with Q3 this year. We think most of this will benefit Suezmaxes and VLCCs because of the longer voyages involved. But exactly how demand for each vessel type is affected will depend to some extent on the price cap. And that's something that we're 4 days away from hearing as well, because we still don't know where that cap's going to be. You know, at the moment, the sort of numbers we're hearing are around the $65 to $70 a barrel, which, you know, when you net it back to a FOB basis in Russia, is actually above what they're getting at the moment. So just as a reminder to people who may not be familiar, under the rules of the price cap, only trades under this level will have access to EU-owned vessels and EU maritime services such as insurance. So under a high cap scenario, Russia's unlikely to have a problem maintaining exports. There'll be lots of vessels, you know, around 50 to 60% of Russian crude and products exports are on EU-owned vessels, majority of which are Greek. But at Kpler, we've been looking into this, and we think that even under a low cap scenario, so where there's very few trades agreed under this price, and as a result, there's few EU vessels available, you know, they're restricted. Here, we think they'll be more reliant on the so-called dark fleet, vessels which have loaded from sanctioned countries, Iran and Venezuela, and the sort of the grey fleet, which are ships which have been sold in the second-hand market in recent months. And we think most of them have come from EU owners in order to sort of facilitate Russian exports. But if it comes to this, we still think Russia will be able to maintain flows. As Ed said, this is the way it works. That, you know, there will be ways to get, you know, the crude and will come out. I think products is a slightly more difficult issue, but it's still going to be possible.
Thanks, Matt. I now turn to Ed for a more macro-related question. Ed, ever since inflation rose dramatically earlier this year, the world has been increasingly worried about a potential recession. What would the likely impact of a global recession be on tankers? Will a recession really put a lid on this hot tanker market?
Yeah, I mean, a recession is really the largest risk, I would say, to the thesis, the long thesis. And we're already seeing a lot of signs of economic fragility in Europe and also the US. You know, just yesterday, we had new economic data about the number of new jobs coming out, which was making it clear that the tightness in liquidity is having an effect everywhere. So I think that the real question is whether the bifurcation of trade, which I alluded to earlier, is enough to compensate for that. Of course, we have something like 100 million barrels of consumption per day worldwide of oil. And so if we have a recession, that would tend to be proportional drop. So if we have like a 1% or 2% lower gross domestic product, then we could expect a similar drop in volumes. But if we're talking about distances which are, instead of going from Primorsk to Rotterdam to going halfway around the world, then that would obviously compensate for that. And then there's a lot of unknowns that I think people aren't really projecting yet. So for example, you know, everyone's talked about the kind of tailwind for VLCCs that the release of crude from the US Strategic Petroleum Reserve has become. And that seems to likely be coming to an end now. But we also know that the Biden administration has committed to buying back and refilling that reserve if oil goes below a certain level. And we're actually getting close to that level now. So the question is, will the US refill the reserve? Where's the oil going to come from? Could that potentially create demand for oil from the Middle East? Because the whole point of a SPR is to be able to have enough reserves that you would normally be importing. So that would create, for example, lots of ton-mile demand in the other direction from the Arabian Gulf to the US, or not, or they might decide to buy a lot of light shale because there's no freight to pay and because it's cheaper. So, you know, that's for an example of something that I think that is an unknown. It's not possible to know that in advance, but that could have a big effect on demand. There's the question of China, which I think Matt alluded to, which is really important. I have friends who are FFA traders in the wet market, and they always tell me, oh, China's back in the market. And then you see a flurry of fixtures from Sinopec. You know, I know that we all look at this data, and it's very clear when China has a presence. China likes cheap prices. They don't like to buy at the top of the market. China also seems to have been diversifying their supply. I think that they're very astute about that. They're not as ideological as we think they are. They like to be able to spread their demand around. So Someone mentioned the incoming flows from Brazil, which I think was a surprise for many people. About 6 weeks ago, all these cargoes, VLCC cargoes from Brazil going to China all of a sudden, that kind of thing can really change ton mileage in a way which is unexpected. India has also, the oil energy minister rather, has expressed the desire to diversify supply, and I think that's a geopolitical play. It's a strength of theirs. They want to show that it's oligopsony. They want to show that the buyer has strength in this market, not just the seller. And so that's a way for them to negotiate better prices for Russian oil. If they can say, well, we can get a better price from Brazil, we don't need you as much as you need us, that changes the dynamics. So I think all of that's going to play into the dynamics for tankers. And to my mind, whether or not global oil demand drops by, let's say, 1 million barrels a day, that's one thing. But if it's going from Brazil to China instead of from the Middle East to China, that's a big change, and it will probably compensate.
Thank you, Ed. However, amongst all this uncertainty, one thing is certain, vessel supply. And I would like to ask Maria and Dylan about this one. First, Maria. Tanker fleet growth is slowing and very few yard slots remain available before 2025. The fleet is aging and IMO regulations will reduce the trading capacity of the fleet. Do these factors, Maria, suggest that the tanker market might better navigate a weaker demand environment than previous downturns, or this is just the standard supply-driven narrative we heard for all these years?
So, IMO regulations and the net zero emissions target for the next decade for sure require heavy investment in improved green technologies to convert ships for green fuels. We have seen a slower fleet growth as there is more scrapping activity and fewer new orders. Currently, there is a new trend. We see more investments flowing for second-hand ship purchases as European ship owners seem that will no longer be able to meet the needs of the Russian oil trade destined for Asian buyers. For sure, we have scenarios about dark fleet, and we have seen evidence about such trading. However, in the last 2 quarters, we have seen an increase in second-hand ship purchases for crude oil tankers from European to Asian ship owners, which also supported an upward trend in ship prices. So, returning to your question, it doesn't look like the new ones, as mentioned before. However, there's a growing concern about weaker crude oil demand from China. The risk of a global recession is still there, and Chinese activity gives disappointing signals following the extensive COVID restrictive measures. However, while uncertainty remains, everything points towards a solid strengthening of the crude freight rates in the next year, and for sure higher second-hand ship prices due to slower net fleet growth.
Thanks, Maria. Dylan, over the last several months, tanker rates have staged a strong recovery. What is remarkable, though, is the almost complete lack of ordering. One would suggest that tankers are out of favor. Your thoughts on supply?
Thanks, Thanos. Yes, it is certainly strange that although the tanker demand has sort of shown this upward trend since the pandemic, we are still, it's seemingly a bit underwhelming on the demand side, but we see these high rates. And so one of the aspects that's been supporting this is coming from the tanker supply side. What you see is with less space in the shipyards for tankers, for new tankers, at least for the next 1 or 2 years, the order books are essentially non-existent. Not only that, but the volatility uncertainty that we're seeing with more expected to come that is also discouraging to some extent new tanker purchases. So it's not only that there's no space, it's also that people are less certain about whether they should purchase a tanker. And so all of this is certainly shrinking the tanker fleet, and that would support rates going forward. One thing I would consider, though, is there is this caveat in regards to the Russian reshuffle of crude. What we could see, and what is looking more and more likely, is a rejection of Russia of this price cap if it ends up being too low. And we've already seen a draft of a decree to reject or not allow Russian companies to sell to price cap nations. And in this case, we could see a lot more tankers move into the shadow fleet. Those are the ones that would be moving the Russian crude more likely in this situation. And at the moment, the tankers that are carrying Russian crude are not the sanctioned tankers that will be doing this sanctioned trade. And so what you could see, especially in the Aframax market, is a sudden increase in vessel supply as those tankers leave the Russian trade and enter the mainstream market and increase vessel availability. And that is one of the supply side risks that we could face going forward into 2023.
All right. And as Dylan and our friends at Vortexa like to say, we distill the top questions on the minds of the market and offer our views in this panel. So now for the end, I also kept a traditional question on outlook. So here it goes. Do you think freight rates will exceed the futures market expectations next year? And to make it easier, let's only talk about VLCCs, the very large crude carriers. VLCC earnings have been remarkably strong over the past few months. Clarksons sees VLCCs breaking through the $150,000 per day barrier. Longer hauls on Russian crude set to shift the dial even further in owners' favor. Freight futures for VLCCs are currently pricing 2023 at about 35,000. So let me go around and ask you for a rough number, but also what could surprise us to either the upside or the downside. I'm also informed that Alex is back. He's been found somewhere in the cyberspace, that he's been lost for a second, and we'll have him also give us his final answer on this one. Maria, we start with you.
Thank you, Thanos. So it seems that the previous quarter, the bonanza we saw in the previous quarter, is still leading the positive market expectations for VLCC. I will not put a figure at this moment as a freight forecast, because I believe that we are in a strong transition period a few days before the enforcement of the ban. So every figure that I will say, it may change dramatically in the next few days. But what I can see from the current picture of freight rates and what I see in the demand is that we see a weakening sentiment in the freight rates for VLCC and stronger momentum in the Suezmax segment. So there's already changing trading patterns for the crude oil that seems that will support more the Suezmax segment at this moment. So it remains to be seen what will be in the next few days around the enforcement of the European ban on Russian oil. And I will put a question mark here. We may see an extension of the ban, maybe yes, maybe no, but let's see what the next week will bring for us.
Okay, Maria, thank you. Ed?
Yeah, well, when it comes to predictions, I always think about this wonderful website some of you may have heard of called Predict It, which often comes into a topic online when there's like a big election somewhere and people actually bet on the outcome. And I think that what's interesting about the freight derivatives is obviously they're very problematic as a predictor. I think it's pretty easy to predict that the rates will be higher than the figure that you you mentioned. And the reason it's easy for me to say that is because charterers, whose job it is to bet and to actually place their money on what is a likely 1-year period charter, we're already in the mid 40s. So if they're booking 1-year VLCCs in the mid 40s, and I think we're definitely going to go above 50 next year, it doesn't mean that freight rates will stay above that the whole year. I think we're going to be surprised both up and down. I think we're going to have really high spikes, but I don't think they're going to last. And I think there will also be troughs, when the recession is really hitting in Europe in the spring and when the seasonality comes away. I think that market participants will be surprised by how low the number goes. I won't say, but I wouldn't be surprised for us to see a 20 handle again, for example, in VLCC rates without squippers and not eco. But I think that the average, let's say, will be higher than this year, which of course was dragged down by this terrible Q1 and Q2. So yeah, I think everyone's going to be surprised in some way.
Right. Very interesting. Thank you, Ed. Dylan?
Yes, I'm not placed to give a specific figure, but I would like to draw attention as well to in the last few months, we've mentioned the volatility, but we've seen TCE earnings for VLCCs go from losing 20,000 a day and to earning up to 100,000 in just the last few months. And so if you look at the next year ahead and the gap that is between where we are now and Clarkson's expectation, we could certainly hit that figure with the current volatility. What Ed was touching on as well, which I agree with, is will it stay there? We don't know if it could be a massive swing to the upside, a big surprise. China suddenly really enters the market and with a lot of strength. And let's not forget that we live in a time where we cannot rule out black swan events like conflicts and things around the world, and those kind of things can also send you right back down to where you started. So I won't say a specific figure, but I could say that definitely we could hit new highs and we could also hit new lows. I would agree that given where we are right now and with what we know right now, we could see definitely a higher average at least for next year.
Thank you, Dylan. Matt.
Yeah, thank you very much. Yeah, I have to admit, I echo most of what the rest of the panel think. I think partly because there's still considerable upside, particularly in the first quarter. So I think if we're going to see higher rates, it's going to be towards the first half of next year. And after that, I think we'll start to see an easing, certainly not a crash, although volatility as it is, we will see low rates. I think Ed made a very good point. People will be surprised, I think, by what we see, but I don't think we're going to see a sustained crash and low rates. And I agree with everybody else. I think the average will probably be above this year.
Thank you, Matt. Thank you. I don't know if we can see Alex. Alex, would you dare to give us a rough number for next year and maybe also have the opportunity for a conclusion on your presentation? Yeah. Hi, Alex, again. Good to have you back. Would you dare to give us a rough number for 2023 on VLCCs? And also, please take the chance to conclude on your presentation before.
Hello, guys. Hopefully you can hear me now.
Yep.
My laptop pretty much exploded for some reason from Zoom, but I think the guys covered a lot of the interesting things here already. One thing I would want to mention, and that's an opinion of mine, is that when we're talking about the ban and the cap specifically for the Russian crude, I consider again the people can be quite optimistic about it. I again consider the amount of money that can potentially be made by buyers who are willing to go around this, whether it would be via shadow fleet or other means. For instance, when we're talking around the market, there's not that many people concerned about Russian crude not flowing. There are multiple STS operations that you can do in multiple places. There are some other ways that you can go around it, and I think we can be quite confident that there is a good amount of Russian crude will still be flowing on longer distances, while it's being displaced in Europe. And that means two things. One thing is that there's going to be a shadow market out there, which is very big. And two, that it will distort what's going on in the main market, because it will consume tonnage, it will consume certain volumes, and whatever rates we see in the general market are not necessarily going to, or earnings are not going to be necessarily the thing which you see in the shadow market, and then they're going to influence each other. In terms of what we're going to see in 2023, I think that the crude freight will remain strong, but volatile, mostly when the market gets spooked. This is an easily skittish market, which often creates its own self-fulfilling prophecies, and gets spooked, jumps up and down. But what we do have is generally stronger fundamentals, because the long haul ton-mile demand is likely to stay there and is likely to compensate the loss in demand when we hit the recession. The recession is, depending on who you ask, is already here. So that might compensate. So we have a stronger baseline for tanker freight, both in dirty and in clean, I think, as well. Whether to put it on a specific number, I'd say we are not likely to see a sustained 100 grand throughout the year, but I think it's going to be higher than we've seen before the conflict happened. But that's one thing, and nothing to consider when it comes to supply. Well, the tanker, again, order book is low right now, and historically low, and it's awesome, and a lot of people already singing about it. Again, ship owners made loads of money this year, right? They're sitting in a lot of cash, some of them, and they will invest it as soon as the time is right. When they decide this time is right is interesting, and yes, you have lack of availability on the yards, and the tankers are very expensive, and there is regulations about decarbonization that you might consider, but this might limit the length of time when you have this shortness of tonnage, maybe by a few years. But if you're looking longer outlook into 2024, 2025, and so on, I wouldn't be so confident that we're not going to have a massive amount of orders coming in as soon as the situation changes, and that will spook the market again, even before the tonnage arrives. Those are the things I'd mention.
Okay, that was great. I would like to thank all our panelists and Alex, of course, for being here and sharing their views. It was indeed a very interesting discussion, and hopefully an informative one that provided some food for thought on the outlook for the tankers market. And with that, I will turn it now back to John in New York. John?
Thank you, Thanos. Indeed, that was a very interesting discussion. And I think that obviously tankers remain a key part of shipping. And I think probably the views are split between a very strong current market, which has been multi-year highs, but also a very cyclical industry that in the past has shown that, it can change in a moment's notice. So let's stay tuned and see what the future brings. So thank you to our panelists for their views, and thank you again, Thanos. This was our last panel of the day. So I would like to thank all our panelists that made this event possible. We hope you enjoyed the discussions, and now you're a bit wiser on those very important industries when it comes to the global economy. That concludes our Breakwave Day. Thank you all for joining. We wish you all the best for the new year, and looking forward to continue the conversation for the years to come. Enjoy the rest of the day.